friends. This is Professor Amarjeet Kaur. I have been working with Gurugram University as professor in the Department of Management. I have been privileged to have worked with Valparaiso University in USA and North Dakota State University in USA as visiting professor. I have industry experience of 5.5 years. This is my privilege that I am here with you to talk about a very important topic on leverage. This is under the financial management discipline or subject. We are discussing these topics. So, leverage is one of the important concept with regard to financing of any project, financing of needs of a company. So, what is leverage? To understand that, we have started this series couple of weeks ago and we talked about 3 important financial decisions. One is investing, second is financing, and the third is dividend decision. So, in the investment decision, we talk about that where should we be investing in, either to buy X plant or Y plant, X machine or Y machine, or to invest in X project or Y project. That is what we decide in investment. We also decide about working capital investment. How much to be kept in cash, in bank balance, in inventory, in debtors, etc., etc. So, even that is investing activity. To invest in different assets, we need funding, right. So, funding can come from the equity sources or it can come from debt sources. So, if company decides to use debt funding in their capital structure, it means leverage exists, which means the existence of fixed interest bearing security, because debt is interest bearing security. We need to pay interest on regular basis, along with the principal money if it is payable in installment, or at the end the principal is made, but interest is made gradually over the life of the debt, whatever it is, after every 6 months, after every month, depending on what kind of loan or debt funding we had. So, this is regarding the financing part, but there are companies which have operating cost with fixed nature as well as variable nature. Debt funding may not exist in few of the companies, but when it comes to fixed operating cost, there would not be any exception. Almost every business would have more or less amount of fixed operating cost. When I say fixed operating cost, I am talking about the salaried people who are on the rolls of a company. Their salary is to be paid by the company every month. It becomes fixed operating cost. If, for example, I am using a rental machine, whenever I need whenever I need to complete a particular task, then I am hiring it as and when required. It is a variable cost. But if I have a fixed obligation to pay rent for a building every month, then it is a fixed operating cost, right. So, the another leverage is when we have any expenditure of operating nature, but which is a fixed obligation to be paid by the company, that is also leverage. So, accordingly, the leverage is the employment of fixed assets or funds for which a firm has to meet fixed cost or fixed rate of interest obligation, irrespective of the level of the activity or the level of operating profit earned. So, leverage works as a magnifying force for any firm to multiply the impact of an action. We have wristwatches, we have wall clock at our homes. So, most of these wristwatches, wall clock, they would have a lever in it. Many machine would have a lever in it. So, lever does what? Lever actually accelerates the function of that machine, of that watch, that wristwatch or wall clock. Same way, likewise, leverage in a business, it magnifies the force for any firm. It multiplies the impact of an action, which action I shall be talking in details in few minutes, but it is So, existence of leverage for a company means a magnifying force existing in the business. It magnifies the earnings of the shareholders, it magnifies the earning before interest and taxes, it magnifies earning per share both. So, how does it happen? We will discuss in detail. So, to define what leverage is, leverage used to, we can say, used to describe the firm's ability to use fixed cost funds to magnify the return of its owner, and fixed cost in the fulcrum, or it is fulcrum of leverage. So, unless fixed cost is there, fixed financial cost or fixed operating cost, either of them, then it is the leverage does exist in that company. It means fixed cost works as a fulcrum of leverage. Higher the leverage, higher is the risk and higher is the expected return. So, that is why we call it as two-sided sword, or a sword which has both the sides, very active. So, in the case of increasing times, or in the case of return, sales are increasing, leverage will work positively. So, it will really add more returns to the business than it would have without leverage. So, it is, but as I said, it is a two-sided sword. When sales are declining, then the loss or the negative effect would also be higher than it would have otherwise, because company has a fixed obligation to pay interest, pay salaries. So, it will not be able to recover those fixed costs because the sales are less, contribution is less, right. So, we call it as two-sided sword. So, higher leverage means higher risk and higher returns, low leverage means low risk and low return. So, it's that's what it is. Now, the leverage, basis on the discussion we talked about, leverage can be of two types. It can be financial leverage and operating leverage, and both of them combined with each other, multiplied with each other, in fact they are known as combined leverage. So, companies would have three types of leverage: operating leverage, financial leverage and combined leverage. I shall be discussing each one of them now independently, and we will also learn how to use this leverage to calculate the effect on profits, effect on EBIT or EPS. So, operating leverage, what is operating leverage? So, operating leverage is the tendency, as I said in a few minutes ago, of the operating profit to vary disproportionately with sales. If sales are varying, and then profits are about to vary, of course they are bound to vary, but they do not vary at the same percentage the sales are varying. They will vary disproportionately, higher or more, depending on the what kind of leverage do we have, or and what kind of sales are declining or sales are increasing, right. So, change in sales could be both negative or positive, right. If I am selling 10,000 units today and next month I sold 12,000 units, means my sales went up. But if my sales have gone down, it could be from 10 to 8,000 as well. My leverage will work accordingly. So, if I have leverage, means there is a fixed operating cost, because we are talking about the operating leverage. So, there is a fixed operating cost, and the effect of the operating leverage will depend on either the sales are going up or sales are going down, means the growth is there in the sales or there is a decline in the sale. So, leverage associated with operating cost structure, whether a company's costs are fixed or variable in nature, that is what defines the existence of leverage. If there is no fixed cost, there is no leverage of operating nature, right. So, we have to have existence of fixed operating cost in the cost structure, operating cost structure of the company, only then we will say the leverage is here. It is affecting positively or negatively will depend how my sales are responding. My sales are going up means I am growing, my sales are going down means I am declining, I have a, I am facing recession. So, recession and inflation, they both affect the effect of the leverage. So there are three factors which are playing role here. The how much effect the leverage would have on the EBIT, the sales, changing sales to EBIT, the amount of fixed cost, because it varies from company to company. So more the fixed cost, the more would be the effect, be it positive or be it negative, and the effect would be more. Then the contribution margin, which is the difference of sales and variable cost. So what is my selling price and what is my variable cost, that will define the amount of contribution margin. And then of course the number of units we are selling, the volume of the sale. So these three factors together, the volume of sale, the contribution margin, which is affected by sales of course, right, and the amount of fixed cost, together they make an impact on the effect of leverage, like how much effect the leverage would have on earning before interest and tax. So the operating leverage is the measure of business risk, that is firm's ability to use fixed operating cost to magnify the effect of changes in sales on earning before interest and tax, which means how well or how bad a company will be able to magnify the impact of change in sales, delta sales I am referring to, which means positive or negative, which means increase in sales or decrease in sales. Both are actually change in sales, right? Changes doesn't mean always positive, don't get confused here. So I am saying changes in sales, which means the sales going up or sales going down. So how does this magnify the effect on the operating income, rather earning before interest and tax for a company? So to understand if operating leverage is, for example, 3, 2.5, 5, whatever. So if I say the operating leverage is 2.5, means the 1% change in sales would lead to earning before interest and tax rising by 2.5, right? If the same way, if my leverage is 2, let's say, right, and my sales are declining by 1%, but my profits EBIT, earning before interest and tax, will decline by 2. Getting the point? It means, so if in the both case, if the leverage is 2, in rising cases my sales are rising by 1 rupee, my earning before interest and tax would rise by 2 rupees. Whereas my sales are declining by 1 rupee, my earning and earning before interest and tax will decline by 2 rupees because of the leverage. The concept of economies of scale, it has to do with leverage. Other than understanding how variable cost and fixed cost function or respond or vary, variable cost per unit remains constant. To have a deeper understanding of the leverage, please be apprised that variable cost per unit remains constant over certain period of time, not forever of course, and fixed cost in total remains constant, which means fixed cost per unit goes down if we increase the level of activity, production or sales here, anything. That is what economies of scale is working. So fixed cost being same, constant for certain period, if there is a change in sales, my profit goes up because of the economies of scale working, because variable cost is the only thing which will vary, which will go up. If I am manufacturing any pen, right, my variable cost is the material I use, the labor I pay for, or any overhead which is of variable nature. Combining all the three values together is my variable cost. So if I subtract my variable cost from my sales per unit, the difference is contribution margin. Out of the contribution margin, I recover fixed cost, and remainder is my earning before interest and tax, right. Since fixed cost is remaining same for certain period of time or up to certain level of activity, it means my EBIT is subject to change, effect or get affected because of change in sales, right. So my contribution margin will certainly go up if sales go up, because sales minus variable cost is contribution margin. But since fixed cost remains constant, it is going to impact my profits, earning before interest and tax, positively or negatively depending how my sales are changing. So that's why the operating leverage has a connection with the cost structure and the behavior of variable and fixed costs. So how to calculate? For calculation of operating leverage, we calculate in two ways. Either we calculate operating leverage and we calculate degree of operating leverage. So operating leverage is actually OL in the formula here. It is calculated contribution margin divided by EBIT, right. So what is contribution margin? Sales minus variable cost is contribution margin, and EBIT is sales minus variable cost minus fixed cost. So we are saying this is how we calculate operating leverage, and this is just the operating leverage. But if we have to calculate degree of operating leverage, then we use the formula degree of operating DOL is equal to percentage change in EBIT, earning before interest and taxes, divided by percentage change of sales, which is basically delta EBIT divided by EBIT, the whole divided by delta sales divided by sales, right. So we are measuring, in fact, as I said, we are measuring how much my EBIT in percentage will change if my sales are changing in a certain percentage. So if degree of operating leverage is 3 and my percentage change sale in sale is 1%, the change in sale is 1% positive or negatively, my EBIT will be changing positively or negatively by 3%, right. 1% versus 3% depending on what is the DOL, and the value of DOL will vary, will be higher, which means the operating leverage would be higher if there is a more fixed cost in the total cost structure of the company. If there is a small amount of fixed cost, like 80% are variable, 20% is fixed for one company, and another company has 40% fixed cost and 60% as variable, and the third company has 80% variable cost and 20% fixed cost. So you see how A, B, C, three companies vary in their cost structure. So the company with maximum fixed cost would have highest degree of operating leverage and higher risk as well. They would have higher benefit as well. They would be having the highest earning before interest and taxes amongst all the three companies because of the cost structure. So sales being the same for all the three companies, mind you, the amount of sales, let us say for all the three companies A, B, C is same, even then earning before interest and tax would be different because of the existence of leverage in their cost structure. It is very interesting. One person will say, I am making sales of 1 lakh and I am earning 20,000 EBIT. Another way, I am saying making the same company, same sector, same product selling, right. Let us assume everything same. Even then their EBIT would be different, selling 1 lakh units or 1 lakh total value of sales for all the three companies A, B, C, but even then EBIT is different in all the three companies. Why? Because of difference in cost structure, because A is using less fixed cost than B, and then B is less using than C, right. So that is the importance of understanding cost structure. Unless you know how your cost varies, what is your cost structure, you actually cannot get benefit of leverage, and you should be knowing how much risks you can. If you are in such a business where there is no risk, your product is in demand, there is not much competition, or you are selling essentials, right. So there is a less likelihood of the variation or variability in the sales. In that case, it is really good to employ fixed costs. But in case you are in a business where you are not sure about the sales demands and you are in uncertain situations, then deploying fixed costs could be riskier. So nature of the business also helps us decide how much leverage to be used for operating cost and how much not to, right. So this is the conceptual discussion. Thus the overall operating leverage shows the impact of changes in sales on operating income. The larger the fixed operating cost, the higher is the operating leverage and operating risk, both would become higher, and higher operating risk is good when revenue is rising and bad when revenue is falling. So, with this now we shall be talking about the practical application of leverage. So, we are done with the conceptual discussion on this topic. So, let us talk about some examples, some small caselets to help you understand how do we calculate this leverage. So, friends, the first example I would like to take is that sales in units for a company are 10,000, selling price per unit is rupees 10, variable cost is 60%, total operating cost is 90%, find out the operating leverage, right. So, here we need to calculate contribution margin first. Sales in total units are 10,000 and what is the selling price? 10. So, if we multiply 10,000 with 10 rupees, the total sales becomes 1 lakh. Less variable cost is 60% of the sales, right. It means 60% of 1 lakh. So, which becomes 60,000. So, if you look at the first row, the first row in the calculation, contribution margin is equal to 1 lakh minus 60,000, which becomes 40,000, right. Now, the second component we need, or second variable we need to solve this question is EBIT. So, what is EBIT? The contribution margin less fixed cost, or otherwise sales minus variable cost, which is contribution margin less fixed cost. So, sales 1 lakh less operating cost in total, because we have been given the total operating cost 90%. So, which is 90% means 90,000, 1 lakh is the total sales, 90% of it is 90,000, it means my EBIT is 10,000. So, what will be the answer? The operating leverage is equal to contribution margin divided by EBIT, which is 40,000 divided by 10,000, which becomes 4. So, answer is 4. How to interpret this answer? If my sales are increasing by 1%, my EBIT would increase by 4%. If my sales are declining by 1%, my EBIT will decline by 4%. That is what this question says. Taking one more example of operating leverage, sales are 100,000 or 1 lakh, cost of goods sold is 20,000 plus 55% of selling price, selling expenses are 5% of sales. So, it means total 55 plus 5, 60% over and above the cost of goods sold is the expenses. Administration expenses are 10,000, find out the operating leverage. So, again we need to calculate contribution margin, which means sales minus variable cost, and variable cost is 20,000, COGS given, 55% of selling price means 55,000 plus 5% selling expenses means 5,000. These three are variable cost, right. COG always cost of goods sold changes as per the changes in sales. Your another 55% is also another variable cost. So, total 80,000 is subtracted from 1 lakh, so it becomes 20,000. And your EBIT, if you subtract another 10,000 from administrative expenses from CM, which is fixed expenses, your contribution margin 20,000 minus 10,000 administrative expenses, which is fixed in nature. So, the remainder would be EBIT, which is 10,000. So, CM 20,000 divided by EBIT 10,000, the answer would be 2, right. So, I hope you are getting me that operating leverage is a very important, very essential thing to understand to run a business effectively. Anybody can run business, but unless the business is making sense, business is able to give you good returns, it is not fun to have such business. So, to have such good effective running business, we have to have understanding of the operating leverage, function of operating leverage. So, then I will take another example here, third one. Let us say decrease in operating income is given to you 66.2% and decrease in revenue is given 33.11%. Find out the operating leverage. So, it is a very direct question where you have been given decrease. So, delta. So, delta, the change in operating income is given, already given, and the change in revenue is also given. So, we simply need to take change in EBIT divided by change in sales, that is what the formula is. So, answer comes out to be 2. This is with regard to this formula, right, this one. The question I was just discussing, here we are applying this percentage change in EBIT divided by percentage change in sales, right, unless the previous 2 questions we used operating leverage, this formula. Okay. So, we will take up one more example here, and we will learn how to calculate operating leverage. Here in this examples, sales are 2000 in the previous year, selling price per unit is rupees 10 and the total operating cost is 17,600. In the current year, sales in units are 3000, selling price remains same 10 rupees and your total operating cost is 21,600. So, how shall we be calculating? We will be applying the formula of degree of operating leverage, change in EBIT divided by change in sales. So, how much is the change in EBIT? I need to calculate EBIT first for both the. So, EBIT would be your 20,000 total sales minus operating cost 17,600 for the previous year, and the second year 3,000 multiplied by 10 means 30,000 less 21,600. So, the difference of the operating, so that gives you EBIT. The difference of the 2 years is 6,000. The difference and divided by the previous year's operating income is 20,000 minus 17,600 means 2,400. So, change delta EBIT is 6,000, EBIT is 2,400, the whole is divided by your sales, delta sales and the previous year sales. Delta sales is 10,000. From 20,000 sales to amount, it is this year it has gone to 30,000. So, delta is 10,000 divided by previous year sales, which is 10,000. So, if you divide it whole, it comes out to be 5, right. So, this indicates that company is at a very high uses of leverage. It has a very high amount of leverage. It will be benefited in rising times, it will be very badly hit in bad times. So, just to conclude that operating leverage shows the impact of changes in sales on operating income, and larger the fixed cost and higher would be the impact. So, we have to be very careful in structuring our operating cost structure, designing our operating cost structure, because it does affect my EBIT because of the change in sales. So, it is a very important practical tool to be used in financial management. So, I hope you were able to gather what we discussed today. It is time to sign off. Thank you very much.